Now, we've got some big earnings today. So one of course, the Mag 7 type stocks actually does report today. Tesla reports after the bell today. That's going to be a big mover in the market. So when the market closes at 3 o'clock today, a few minutes after that, Tesla will report. So if you're watching the market after close, you're going to see the ES and the NQ possibly make a big move, because whatever Tesla does, they're going to move with it. So just be prepared for that at the end of the day. I'll probably do something in Tesla. As far as if you want to do something in Tesla, it's got obviously good IV because the market's, got juiced IV everywhere. But you could always do Strangles or Iron Condors. Those are smart plays, being kind of a high price stock and kind of a risky stock as far as, it tends to make some big moves. I'd probably stick to something defined risk like an Iron Condor if you're going to play this. If you want to be directional, if you want to take a directional shot, I think the only direction you could possibly make a bet on is to the upside. It's very hard to start buying puts on something that is pretty much at its lows, right? So it went from 488 trading right now at 231 is where it's at pre-market. More than half of its value has been lost in the last couple months. So if you want to take a directional shot, I think you have to buy some calls or buy some call spreads. Like buying puts or put spreads just seems like you're not going to get that move. And I say that because Tesla is going to report bad earnings. But everybody knows they're going to report bad earnings. It's already priced in. The bad earnings were priced in throughout this. We know their sales are down. There's nothing they're going to say after hours today that's going to shock anybody. The only thing that could shock anybody is if the earnings were actually good, which it's not going to be. So I just don't think you're going to get enough juice to the downside, betting on a down move. So if you're going to be directional, I'd play it to the upside. I think the smart move probably is just go out about 60 days and sell an Iron Condor and just try to profit from volatility. Other things reporting after the bell today, In-Phase Energy, which I haven't played this lately. I used to play it all the time. The stock just was very difficult to trade. I lost money on this practically every time I've traded it. Tends to be very volatile, make some crazy moves, but you also don't tend to profit a lot on the volatility. Sell a lot of Strangles on this. I have in the past. And it was just very tough to make money on this thing. But right now, wow, I can't believe what this thing is trading at, because I remember trading this thing when it's like $300 a share. What was, yeah, $339.88 is the high. And let me refresh that chart. It is trading pre-market at $52, right? That's crazy. So you want to talk about, this is another one, like if you got to be directional, it would be very hard for me to load up on something that is this beaten up, as far as load up on puts. Can't do that. If you're going to be directional, buy some calls. If you're not going to be directional, because it's such a low price stock, that's one I'd probably do a Strangle rather than an Iron Condor. Although sometimes with things that are this beaten up, you do kind of worry about the call side of a Strangle, because, could this thing have a big up move? Certainly possible, especially with the overall market being down the way it's, down. People are looking for some buy opportunities. So I would be worried a little bit about the call side of a Strangle, but, that's probably, for me, that's probably what I would do in this if I play it. Some other things that report, we got a few things that also report in the morning. Let's see. Yeah, these are less interesting. Boeing, I typically don't play Boeing. Let's see if it actually loads here. BA trading right around, well, pre-market it's up about $4, trading at 163, well off its highs. You guys remember when the planes were, losing parts in midair. This thing was trading at 266, a few months back, and then that was before like the doors of some of the planes started coming off in midair. They were losing panels. And this thing has really never recovered from that. And then, of course, the market overall has been weak the last couple of months. So IV rank of 48. Let's see what the IVX in this. 51%, pretty good IVX. Yeah, this one's probably, a good Strangle candidate or an Iron Condor candidate if you want to profit from the vol contraction. Go out about 60 days, 59 days is the June monthly cycle. Now, that's kind of the go-to on a lot of these. Do a Strangle or an Iron Condor, depending on whether you're comfortable with undefined risk or you'd rather do defined risk. Other than that, using plenty of buying power. I don't need any trades, but Tesla, let's take a look at Tesla. All right, Tesla's up $6 today. IV rank of 55. IVX, wow, 87%. Very, very volatile. So Tesla, do I want to be directional or not? Typically on something like this, I would do an iron condor. I'd try to collect about 65 to 70 cents or so on the put credit spread side. And that gets me down all the way to the 170 put. So Tesla would have to fall, $65 to really threaten that side. So that's pretty far out of the money because of the volatility, right? When you got volatility this high, you can get crazy far out of the money. And then I need to try to collect about the same on the call side. Let's see, where call side though, we got to lean in quite a bit to make, the same kind of 65 to 70 cent credit. So they're not giving us as much room on the call side as far as, the deltas. But dollar-wise, it's still the same, about $60. So I'm about $60 away on each side of the trade if I wanted to do an iron condor. So that's kind of your standard volatility play. Go out about 60 days, sell a strangle or an iron condor. If I wanted to be directional, again, you got to be bullish. So, I mean, even in the 3-day cycle, a call is very expensive. And then the long options are very expensive because volatility is jacked. In the 3-day cycle, IVX is 142%. You're going to pay a lot of money for that. Probably not wanting to, make a 50-50 kind of bet and spend $1,200. It's probably not what most people want to do. But you can turn it into a debit spread, do a call debit spread. And now you're spending about $250 to make $250. It's basically a coin flip kind of trade. You're betting on it to go up. You can adjust the strikes, however you want to adjust it here. The 232.5 and the 237.5 would be exactly like 250 to make 250. Risk 250 to make 250. If you wanted something cheap, lottery ticket kind of play. And just because this thing has been beaten up, if you wanted to bet it to the upside, I'd go a little further out of the money, and do a debit spread, like a call debit spread. Maybe in this case, make it where I risk 100 to make 400. Just because I do think, this thing is much more likely to move up in a big way than down in a big way. Although realistically, it's probably much more likely not to make a big move in either direction. So you may want to do the iron condor. Nobody really knows where this thing is going to go. Your guess is as good as mine. But if you had a directional assumption and wanted to play it to the upside, call debit spread kind of makes sense. Because you can size it however you want to size it. Depending on how far out of the money you go, you can make it as cheap or as expensive as you feel comfortable making it. Obviously, the further out of the money you get, the cheaper it gets, but the less chance you have of actually winning on the trade because you need a much bigger move. For me, I don't mind spending $100 on a lottery ticket kind of play. Let's see if they'll give me this for 98 cents. ON Semiconductor up 54 cents. That's nice because I've got this one short put now that is a little bit in the money. I need ON to get back above 37 to be out of the money, but really I need it to be quite a bit higher than that because it reports earnings in 13 days. I really don't want to hold this through earnings. If I wanted to, 24 days, typically you'd manage at 21 days, which would be this Friday. You'd roll it or close it or, get out of it. But 24 days is close enough if I wanted to. I could go ahead and adjust this to a new position. I could go out to the June cycle. So roll from 24 days to 59 days. I'd get an extra 92 cents credit. I don't want that extra 92 cents credit. I would use that to roll down to say the 35 strike, which gets me back to essentially at the money. So I rolled out a month and down $2, pay $9 debit, but it's a nothing debit. It's essentially rolling for break even. Now, if I wanted to lower this even more as far as the strike, what I could do is I could sell a call to finance me rolling this further. I could sell the 16 Delta call, yet, I don't know, 60 5-cent credit or something, whatever the mid price on that is, and that would help me roll even lower. You know, I could possibly roll down to the 34 or the 33 strike by adding the call. Now in this case, because earnings are coming up in 13 days, I don't even know if I'd want to make this roll, because do I really want to hold this position through earnings? It's really not helping me, because I really don't want to be in that short put at the 37 strike, even at the 33 strike. I don't want to be in that short put through earnings. So I'm probably just going to hold this for the next 13 days. Wherever it ends up, you know, I'll either get out of it, or if I'm in a good position, I may leave it on. We'll see.